Welcome to the step-by-step guide with examples on how to buy put options for beginners. So if you're looking to learn what put options are, how to buy them, how to make money with them, and most importantly, how to minimize your risks and don't lose money, well, this is the perfect video for you because I'm going to be going over live examples, showing you exactly how I would make money by buying put options and also hedging my risk and managing my portfolio. I'm going to break everything down for you super simply. So what is a put option? A put option is a deal between a buyer and a seller, the same as a call option, except a put option is a bet on a stock falling down. Buying a put option, you can profit from a market declining or a stock going down. A put option gives the holder the right but not the obligation to sell Starbucks at the price that you choose, the strike price, within a specified period of time. This means that if the price of the underlying asset decreases below the strike price, the holder can still sell at the higher strike price, thereby profiting from the decline in the asset's value. I'm going to give you an example right now. So Starbucks stock price, $73, and you buy a long put option with a strike price of $70, okay? You pay a premium for the put option. Let's just say you pay $1, hypothetical example. As Starbucks falls to $65 per share, here's what it's gonna look like. With the stock price dropping below the put option strike price of 70, the put option becomes in the money. So for a put option, it's in the money when the stock drops below the strike. You know, for a call option, it's in the money when it goes above the strike. So for a put option, you want it to go down. When it goes down, you are making money. So this means that the holder of a put option now has the right to sell Starbucks shares at the higher strike price of 70. So if Starbucks comes crashing down, you're perfectly fine with that because you get to sell it at 70 no matter what because you own that put option. Even though the market price declines and it goes down to 65, that's perfectly okay. So the put option holder can buy shares at the market price of 65 and then he can sell at a higher price of 70, realizing a profit of $5. Since each option contract typically, in all cases represents 100 shares, the total profit would actually be 500, the $5 times 100 shares. So deducting the premium paid for the option, which we said was $1 or $100, that means we have $500 of profit minus the $100 that we paid, which gives us $400 of profit. Let's do another example, another scenario. The long put option in the prior example that we just did was, basically making us $400. But in this example, what I want to go over is going to be a different stock. So let's take Apple, okay? Let's say that Apple right now is around $175 and then we're going to buy a long put option with a strike of 170, okay? So we're at 175 and we're going to buy a 170 strike, okay? We think that the stock is going to fall down and we're going to pay $2 for this, okay? A little bit higher premium here. And let's just say that the stock does fall down, but it only falls down to 171, okay? So here's how the scenario unfolds. Since the stock price is above the strike price, the put option remains out of the money. The holder of the put option doesn't exercise the right to sell the stock at the strike price because, well, it's not profitable to do so. In this scenario, the put option expires completely worthless. As its holder wouldn't really exercise it, there would be no point. There's nothing to exercise. There is no intrinsic value. And there's actually no extrinsic value either when the option expires and there's no more time left. So it is a complete loss when the market price is above the strike price in the case of buying put options. The loss would be the premium paid for the put option, but good news is you can't lose more than what you pay when you're buying options. Therefore, in this case, the net loss per contract would just be the $200 that you paid, the $2 times 100 shares for each contract. So $200 would be your loss. Apple stock price fell from 175 to 170. However, it did not reach our strike price of 170. So this is an example of a put option that you can buy where, whether you want to hedge your portfolio, whether you just want to make money on the put itself, right? That's fine. There's two different ways you can make money when buying puts. You can make money by the put option going down, or you can save money when the stock goes down and you actually hold the shares and you're able to get out of the shares with your put option. You're able to actually exercise a long put option and get rid of your shares. But in most cases, you will probably be just buying a put option. So if you're just buying a put option, you would experience a full loss. Now I want to go over another scenario number 3. We'll just pick any other stock, maybe Chipotle, $3,000, okay? You buy a long put option strike price, okay? And you buy a put option for $2,900. So the stock is at $3,000, you buy a $2,900 put, and you pay $100 for the rights basically of buying this put option, okay? Now let's say that the stock does fall below your strike price. It falls to $2,850, okay? So the stock was at $3,000, you bought a $2,900 put, and now the stock falls down to $28.50. So you're in the money by $50, but here's how the scenario unfolds. With the stock price falling down to $28.50, in actuality, you are in the money by $50. However, because you have paid $100 in premium to get into the option, right? You bought the option for $100. Even though it's in the money by $50, you actually still end up losing because the premium you couldn't compensate for. You couldn't make enough money on the downside to compensate for the premium. So in this scenario, when the stock goes down from $300 to $28.50 and your strike price is $2,900, yes, you're in the money by $50. But because the premium paid was $100, okay, the $100 per share, the net profit here would actually be a loss of $50 because you have $50 in profit, but you paid $100 in premium per contract. Since each option contract is 100 shares, that means that this would be a net loss of $5,000. So buying put options can actually be really expensive and you can lose quite a lot of money. So you want to be very careful to have proper position sizing and risk management in place, which I will talk about very shortly in this video. Actually, let's talk about it now. Now that we've learned how to buy put options, well, you can just start buying them, right? But, it's really not that simple. As you saw in the scenarios, you can not only make a lot of money, but you can also lose a lot of money. So you want to be very careful about how you go about buying options. With a put option, it's just like a call option. If it doesn't reach your strike, you lose the amount of money that you pay for the option. The good news is that, again, you can't lose more money than you pay for it, and you can recoup some of your loss or some of that premium if it goes slightly or partially in the money. So you can make varying amounts. That's where actually risk management comes into place. That's where taking profit comes into play. You may not want to hold the option until expiration. Oftentimes, when a stock moves towards my direction, towards an option that I'm buying, I will almost always typically pick an exit point. So for me, an exit point may be when I have a 50% gain, when I have a 75% gain, or maybe even when I have doubled my money. So let's say that I spend $1 on an option contract, so $1 on a buy put. If that put option now becomes worth $2 in a short amount of time, now a short amount of time just depends on the total amount of time. So for example, if I'm trading a 1 week option, then a short amount of time might be a day or two. But if I'm buying an option for 6 months out, a short amount of time may be 1 month. So a short amount of time is really relative to the holding period in general. So this is really important because this is how you risk manage. This is how you take profits properly. Is for option buying, you almost always want to close this position and have an exit plan as soon as you have an entry plan. So it's really important to understand, hey, I want to enter at this price. Okay, so you want to buy a Apple 170 put. You think Apple's going to go down. That's good. But if Apple goes down to 170, as we saw in our scenario, we may not have a profit because there's still a lot of premium at expiration. However, before expiration, if it's only 1 week in and there's still 3 more weeks left, that's a really good move. And if it goes into 170, you're not really in the money yet. You're at the money. You can even be a little bit outside of the money on a long put option. You can be at 170 and 50 cents, which is 50 cents out of the money. However, this put option might already have a gain. If the put option already has a gain of 50% or even more than that, you may discuss with yourself and say, hey, self, I think this is a good time for me to take profits. I'm very happy with the return that I have so far. And in this case, I would say that that's fine to take your profits. You can take profits early and often. There's never anything wrong with that. So I do want to dive into some techniques that can help you limit potential losses, as well as looking at a stop loss or a stop limit order. All right, so we're going to jump into my Robinhood right now, and I'm going to show you an example of how I would run a buy put on Starbucks. Okay, so I'm going to go to trade options, and what I'm going to do right now is I'm going to pick a put option for the future. So let's say that I'm going to just go out for something like July 19. Let's say that I think Starbucks is going to fall further for whatever reason. Let's say that I think that people are going to drink less coffee. I think that the balance sheet isn't looking good. They have a lot of debt. Whatever the case is, you want to find a stock that you are bearish on. It's also really good to find stocks that have bearish momentum on the downside. So talking about technical analysis, which we'll get into a little bit later. All right, so let's go to buy put. So we're going to go buy put, and then I am going to pick something like the 70. Okay, so if I click right here, you will see that I have a highlighted and the premium is $1.44. So I have to pay $144 to hedge 100 shares of Starbucks. Now remember, when you're buying put options, you can either make money on the option itself, or you can also hedge your portfolio if you already have Starbucks stock. Let's just take scenario number 1, because in almost all cases, you're just buying to speculate. You're buying to make money. You're not buying to really hedge your portfolio, although you can use use this, and I do have some training on this, but let's just focus on scenario number one. You're buying a put option to basically make money on the option itself, okay? So if I go right here, you can see here how at the top right, I have a few different things. I have a limit, I have a stop limit, and basically that's it for this position. So what I can do with a stop limit right here is I can trigger a limit order if the bid price rises to the stop price. So if I click right here, you can see here now that I can set a specific stop price. Okay, so in this example, I can go in and I can type in, let's say 1.42, and then for the stop price, I can say, hey, I want to be stopped out at X price. Now, I'll be completely honest with you, stop prices, and just in general, let me go to another limit order. So you can also do a limit, so you can buy order at a maximum price or lower. So you can say, hey, let's say it's at 140, I want to buy it at 130. I don't want to pay more than 130. In that case, when you set a limit, you actually won't get executed on this trade at all until it reaches that 130. So you can say to yourself, well, I'm only willing to pay X amount of dollars. You can set a limit order. You can also set a stop limit, basically saying that, hey, I've made X amount of profit, I want to stop here. And Robinhood or any brokerage can trigger a specific order to actually get executed at a different time based on a price that you pick. Now, I'll be honest, I don't typically do this, and you can do good for a day, you can do good till cancel. You can basically have these orders automatically making money for you. Say that you're at work, you're busy, you can say, hey, I want to get in at this price, I want to get out at that price. So you can set predetermined prices for yourself in the future. However, I will say that my typical risk management strategy is to not necessarily use stop limits or stop loss orders, but more so limit my position sizing. So position sizing is the most important thing. You can have some losing trades if the position size is small, it doesn't really matter. And if the position size is really big, that can be the end of your portfolio. So you really do not want to do that. And you can take an example like losing weight. You can have a little cheat meal here and there. You can have a cookie, a snack. But if you end up going on a binge eat and you eat a whole cake worth 10,000 calories, that's going to set you back. The same thing with trading. If you end up making one bad trade, it can set you back quite a lot. So you want to make sure that you have proper position sizing, which for me can be anywhere from 1 or 2% of your portfolio for option buying. Now, when you're option selling, it's a whole different game. I have lots of videos on this YouTube channel talking about option selling, which is primarily what I do to make currently around $80,000 per month selling options. So that's what I do. But when it comes to buying options, you want to be a lot more conservative, a lot more safe. When buying a put option, you honestly want to have a small position size, like I said, but you also want to really limit it to 1, 2, or 3 contracts. Or if you want to protect the position that you already have, a put option can perfectly get you out of a position you already own, because you get to pick a strike price and basically exit a stock at that strike price, however many shares you have. So if you have 200 shares, you can buy 2 contracts. Again, this gets a little bit more complicated, and that goes into the hedging territory of using put options. You can simply just make money by buying a put option and selling a put option as it makes money.